Hi, good afternoon, everyone. Thank you for joining us today. We got an exciting lineup. We also got a big calendar here in the next 5 days. We got Halloween coming up this Saturday, as well as daylight savings time on Sunday. We're gonna fall back. And we also have elections coming up on Tuesday. So it should be an interesting 5 days. Today, we're gonna go over the third quarter market review. Some quick Ariana news. She is now 3.5 years old. She loves doing her drawings, as you can see right here. Every day we're getting pictures and the pile of paper just keeps on collecting, which is nice to see. And she loves to play pretend. In the morning, she'll get up, Daddy freeze, and got to stay there motionless until she says I can unthaw. So she has a huge imagination at 3.5, and it's beautiful to see. We're also adding an addition to our family next June. So Ariana is going to be a big sister. If everyone could just keep us in your thoughts for a good pregnancy and a healthy birth come June 2021, that'd be great. Thank you. Okay, third quarter markets, they continue to grow, as we can see right here. Only single digits this time. So back in Q2, they were double digits earnings. As we can see here, many of the equities in the US emerging markets were double digits on the growth. Back in Q1 though, it was a different story. So we had double digits on the downside, especially in the equity market with the stocks, the US, international, and emerging markets on the stocks. Year to date is good news. Right here you can see the green bar. The US is in a positive number in the single digits, while international and emerging markets are still lagging behind. The three blue lines right here on the graph are US bonds, international bonds, and emerging market bonds. They're in the positive as well, as they should be. So bonds act as a ballast or a stabilizer in your investment portfolio. These numbers are all as of September 30th, 2020. On the left-hand side here are sectors within the markets. In Q2, we saw a huge increase in technology. They were right up at number 1. As we can all see, we're shooting this video right now. But what took center stage this time was consumer discretionary. And what this is it's not essentials, not essential goods. You're looking at your appliances, your cars, or entertainment. These are all growing right now, as well as materials and industrials. These are your plastics, your concrete, your building materials. People are out there building and growing. These are showing signs of the economy moving in an upward direction. One sector that's still down quite a bit is energy. It was down about 19.7 on the quarter, and it's a whopping, almost 50% for year to date. So right now with the global oil crisis, things are still down with oil. Bond markets are looking good. There are new issues coming up, it seems like every day. There's over 10 trillion with the T of new bond issues that have already happened this year. And what's happened is big corporate companies are leveraging credit at a low interest rate. So they're restructuring, building out their operations. And what that means for you and I, as consumers, well, it can also be for loans on refinancing. Some of us may have had loans from 4, 5, maybe 6 years ago or even more at a 4, 5, 6% interest rate. We can now refinance that debt to a 30-year at less than 3, and even a 15-year at about 2.5. So it's a good time to look at refinancing to see if that makes sense. Today's themes, we're going to go over the economic recovery, which is lagging. And we're also going to go over the market recovery, which is forward thinking. We're going to touch on the elections and the markets, also looking through a long-term lens, what we see moving forward. Economic recovery is uneven, and here's why. Q1, we fell off a cliff right here, and GDP, gross domestic product, for the quarter was down -5%. Then we had some artificial inflation, coming up in Q2 here, there were still lagging indicators. So the second quarter was still down about 30%. Numbers came out today, October 29th in the morning, and the Q3 numbers were up positive 30%. So there's been some big growth, but indicators are starting to level off. And part of that has been to businesses reopening, which is a nice sign to see. We're not going to see more growth until we get full vaccine. And we should see that later this quarter in Q4 or early Q1. But markets have been rebounding. Some parts that have not been rebounding so well are travel, as you can see here, and the little light blue line right here. Now, people aren't getting out there and traveling as much, both domestically and internationally, as well as the next line here with the purple, people going out for dinner. So that's still lagging, and that's behind, as you know, it should be right now, because people aren't going out as much. Up at the top, people are still buying new homes. As you can see, this right here, the graph line is going in an upward direction, as well as consumer transactions, people purchasing on their credit and their debit cards, which is right here on this line. That's still going in an upward direction. So good to see for signs of growth in the economy. Since 1933, there has been 14 presidents, 7 Republican and 7 Democratic. And if you had $1,000 back in 1933 and late 1940s, early 1950s, that $1,000 turned into $10,000. And then later in the early 70s, that $1,000 turned into $100,000. $100,000 then turned into $1 million coming in the early 90s. And from that million turned 10 million in the late 2018. So what this shows us is time in the market, it's going to grow. Democrat or Republican, it's still going to grow in the forward direction. So what this says is we stay invested. What about a sweep or divided party win? If it's the Republican president, Republican sweep, Democratic president or a Democratic divide or Democratic sweep, things are going to be okay. In the end, things end up moving in the forward direction. Right now, as we all saw in the last few days and weeks, we saw a lot of volatility. And right now in this red oval box right here, red oval, there is extreme volatility. As you can see, end of October, early November, there's a lot of up and down movements right here. This is expected and this is normal. This is history that goes back to 1929, so a long time ago. And right now with uncertainty, we're not sure exactly who's going to take office here come next Tuesday. Once we do know, after November 3rd on Tuesday, could be a few days after, just because of mail-in ballots, markets will start to calm down a little bit, which is a good sign. And for us, we want to continue moving forward. So the economy has lagged, it is picking up slowly, but it's very important to remain disciplined and focus on your long-term goals. Us as advisors, we want to manage your downside risk, okay? We want to keep hitting you singles, doubles. We don't want to hit you a home run or strike out. So we want to keep that at a single to a double. If anyone has any questions regarding anything on your investments and we need to make some adjustments, just let us know. But us as a team, we're looking long-term over the next 5, 10, 15, 20 years. And with that, we want to thank you for joining us. So everyone have a wonderful day. We hope to see everyone soon. Thank you.